I think policymakers need to know a few things, and I think we need to have coordination, Kelly. I know that a lot of people are saying maybe the market should shut down, so let's talk about that for 30 seconds or less. What's important is you don't know if you're going to have pent-up demand for buying or pent-up demand for selling once that comes off. Everybody has said on this show, and they've said it historically, we don't know what the numbers are going to be, so it's really difficult to predict. So what I think would make really good sense is to have the marketplaces tighten up its circuit breakers. Today, as you know, it's 5% overnight, and then it goes 7, 13, 20, and after 20, you're halted. I think we should go 7, 13, and halt.
Wow.
Either that or we should go 7, 10, and halt. But we should not close the marketplaces because we don't know what's going to happen.
Terry,
so I'm not talking my own book. I am actually thinking that we tighten it up a little bit.
Sure. Before we even continue, let me just stop you on this thought. Why? So why these circuit breakers were instituted several years ago? What is it about the trading behavior today that tells you we shouldn't let markets go that 13% or that 20% down in one session? Certainly, are you basically saying the liquidity has gotten so bad that the circuit breakers need to be tightened up?
No, Kelly. Not saying that. We are dealing with something we have never seen before. We're not dealing with the financial crisis as you and your guests continue to talk about. We're dealing with something completely unknown. And when you deal with unknowns, you should look to tighten it up to make sure that the public has an ability to manage their risk, but at the same time not let their risk run wild. So that's the reason I'm saying that. Not because of illiquidity. We're doing $1 trillion a day in notional and E-mini S&Ps every single day. It's not the liquidity, Kelly.
So here's what I'm trying to understand. What would tightening that up accomplish if you're saying, look, we don't want to close things. We want to make sure that people are, if it wouldn't accomplish anything, why do it then?
No, Kelly, it would accomplish a couple things.
Okay.
You have a lot of people, including Scott Wapner, who works for CNBC, tweeting that the market should be closed. My point is that would be wrong to close the marketplace. There's a lot of people in Washington don't know what to do. They think maybe should they close the marketplace. That's wrong. What you should do is just tighten up the bands for now during this very stressful period, but yet don't close them. And then also, you have ETFs, Kelly, as you know, that are trading outside of these bands that are becoming leading indicators. How is this even possible? Do not be in coordination with the overall equity market. So, Kelly, what I am suggesting is that we all be in coordination, but we might just need to tighten this up a little bit to take a little bit of the volatility out of the overall market, not shut them down. Tamper the volatility.
Now, that's an interesting point, too. So we've all taken to watching the Dow, the S&P, the QQQ ETFs to the NASDAQ as a proxy for, hey, if the markets were open, this morning was a great example. I'm looking at futures halted and saying, OK, I get it. They're halted down. I think it is 5%, but the Dow would be down 11% right now. And I can see that because that ETF trades as of 4 a.m. Are you saying that in order to make sure that, what's the point, effectively, we should not allow for those ETFs to trade and kind of give us the information anyway? Kind of undermines the point of having the futures halted, or not halted, but again, price limited.
You got to coordinate with the underlying securities markets, futures markets, and other things. You cannot have the ETFs, which are highly illiquid, determining what the overall multi-trillion-dollar U.S. equity market is going to do. That's my point.
So, Terry, let me get this straight. So you're saying there is no, so I'm sort of thinking about it from policymakers' point of view here, there is no liquidity problem. You're saying you're seeing a ton of action in terms of people showing up to trade, price discovery, it's working. But you're saying for the general public that, maybe a way of taking some of the pressure out of, and the volatility out of this situation is just by having trading halted if we hit something like 13% instead of 20%.
That's all I'm saying, sir. I am saying that don't close down the markets because you don't know what's going to happen when you reopen them. Everybody thinks that the waters will be calm and will open straight up. I mean, maybe that is the case, but it's a very big risk to take. And because there's so much money being managed passively versus actively, you don't know if you're going to hit a massive amount of stops with all this passive money sitting in the market that hasn't even transacted yet in the overall market. They have different levels. They're not actively managing their portfolios like they used to. So I don't know what the case is, but I do know one thing. You should at least leave the markets open so people can transact, but at the same time, be responsible about it during a time of crisis. This is not '08, Kelly, as everybody is saying. This is a virus of which you, me, and everybody else knows nothing about. We're not MDs, and we should let the professionals tell us what to do. And at the same time, we should at least think about coming up with some new solutions so people can transact business.
Yeah. All right, Terry, thank you. Thanks for joining us today.
Thanks,
Terry Duffy,
Appreciate it.
CEO of the CME Group.